Hi, everyone, and welcome back to the Nick Halaris Show. Our guest this week should be familiar to a lot of you. It's his second time on the program, Darius Dale, the founder and CEO of 42 Macro. Darius, welcome to the show.
Nick, it's great to see you, man. I'm glad you and your family are doing well, considering everything that's going on out there in California, man. So just appreciate you having me on the show.
Yeah, of course. Thanks for agreeing to be here. I've been really looking forward to this conversation because, um, been following your work for quite some time now and have noticed in recent times some very interesting commentary back and forth about some very popular Twitter topics. And yeah, I think the audience is going to get a lot out of this conversation because there's so much hype out there and so much sort of misinformation or disinformation that you're like a rational voice providing some actual fact-based analysis, and looking forward to sharing it with the audience.
Yeah, I appreciate you saying that, man. We're a data-driven centrist, always have been, always will be.
Yeah, absolutely. Well, the topic is the Department of Government Efficiency, or whatever it's called, the Doge. And I know you've done a lot of thinking on it. So maybe we start with just sort of like set up the high level, your high level analysis of what a Doge could do, what it can't do, and then we'll get into some of the nuances.
Yeah, no, I think we can set it up even higher than that. Let's start by, okay, what even is this entity and what is it tasked to do, right? The Department of Government Efficiency, at least according to President Trump and the Elon Musk and Vivek Ramaswamy, who he's tasked to lead this extra governmental organization. They've been specifically tasked with finding waste, fraud, and abuse and eliminating that from the federal budget. Obviously, there's the assumption associated with eliminating waste, fraud, and abuse implies some efficiencies to be gained with respect to changing how programs operate or work. So the general takeaway amongst investors is that we're expecting the consensus is expecting Doge to achieve significant deficit reduction. We've been on the other side of that for really this entire deliberation process, having now done what I think is among the best data-driven research on this topic beyond Doge, just in terms of understanding federal budget dynamics. We've identified several whole categories of expenditures that are unlikely that are going to be ring fenced from the Doge process. And if you ring fence those categories of expenditures from the Doge process, it's likely that we're going to wind up with significant expenditure reduction as a function of the Doge process on the order of hundreds of billions of dollars. However, we may not wind up with significant deficit reduction because these Doge cuts are likely to offset or be offset by what are likely to be reduction in tax revenues relative to the baseline. Maybe not an outright nominal reduction in tax revenues, but relative to the baseline associated with the expiration of the Trump tax cuts or the Tax Cuts and Jobs Act. Many of those provisions expire on December 31st this year. And so when you net it all together, we sort of wind up in a place where, maybe you see a little bit of deficit reduction, but you're probably not going to see a significant amount of deficit reduction. And more importantly, the size of deficits suggests that we're probably still going to be on a fiscally unsustainable path by the end of this process, this Doge process, the reconciliation process associated with extending and expanding the Trump tax cuts. So I think the kind of key takeaway is that consensus is expecting Doge to take a chainsaw to the budget, the fiscal deficit, and we are sort of expecting Doge to take kind of like maybe not somewhere between chainsaw and butter knife, maybe like a nice steak knife, if you will, to the budget deficit, and it may not result in deficit reduction, just given the likelihood that we see an extension and expansion of the Trump tax cuts.
Yeah, thanks for that. Yeah, it's one of these weird conversation pieces because there's really two issues. There's the issue of the waste and the fraud,
Yeah.
which you mentioned, and then there's the bigger question, which is the deficit.
Right.
And I think that from a geopolitical, strategy standpoint, like the deficit is the ultimate problem.
Yes.
And I think that there's this belief out there, if you listen to the chatter on Twitter, there's a belief out there that this program is going to magically deliver the deficit reduction. Even though it looks like like you mentioned, once you start evaluating the budget, like the probability of that happening is zero, and it actually most likely is going to go in the other direction. But I don't think, putting that aside for a second, I want to just get your take on the waste and fraud. Like undoubtedly there's waste and fraud. Like how big of a problem do you think that really is, just based on the stuff that you've looked at?
Yeah. So based on the analysis that we found, we've identified roughly $516 billion of federal expenditures in fiscal year 2024 that were spent through unauthorized programs, so programs whose funding had expired, yet they were continuing to be spent or reappropriated from other places, somewhat illegally. I guess you can make the case that Biden administration may have done this legally, but obviously, if there's no enforcement, then there's no issue there. So it's our expectation that we're probably going to see at least $500 billion of that type of spending to get eliminated in this Doge process. To me, that's the low hanging fruit. The high hanging fruit is the other stuff whereby you have to potentially change the means testing associated with the program, like Medicaid, which is health insurance for sort of people on the lower income of the income distribution, or you think a program like welfare, which is income support for people on the lower income of the distribution, potentially changing those means tests associated with those programs, or potentially pushing them to block grants for the states, kind of essentially getting it off the federal coffers, if you will, and kind of forcing it to be a state by state issue. These are all things that could potentially achieve hundreds of billions of dollars of additional expenditure reduction. And so it's our belief that when you kind of tally up all the things that Doge is likely to do and actually implement, the recommendations that they're likely to recommend and ultimately have Congress implement, because again, this is an extra governmental agency with no actual power to legislate the federal deficit. That investors need to be very aware of that. These guys are just making recommendations to Congress. So it's our belief that we may see somewhere on the order of about $1 trillion of a reduction in federal expenditures, and that's significant because we'll show here in this chart. We show our fiscal policy monitor, which helps our clients understand kind of all the puts and takes with respect to federal expenditures, federal revenue, and ultimately how those things flow to and impact the deficit. Right now, federal expenditures, if you look at it on a calendar year-to-date basis through December of 2024, we're just shy of $7 trillion at $6.9 trillion. We have the belief that Doge is probably going to find somewhere upwards of $1 trillion worth of expenditure reductions in this process at some point in 2025 or maybe even early part of 2026. By the time they're done making all the recommendations, we would expect to see at least $1 trillion, or not at least, but somewhere upwards of $1 trillion, somewhere between $500 billion and $1 trillion. And if we saw the high end of that, the budget deficit, which is about 7% of nominal GDP currently, would essentially shrink, assuming no change in revenues and obviously no other changes in expenditures. The budget deficit would shrink to about 3.5% to 4% of GDP. However, that's not the only thing that matters, right? We're talking about extending and expanding the Trump tax cuts, and relative to the baseline of that calls for them to be expire on December of this year. That does represent a reduction in federal revenues relative to the baseline. In fact, when you look at the baseline, we show data from the Committee for Responsible Federal Budget here. Some folks have found beef with them, on the Republican side of the debate, because they essentially call out the fact that extending and expanding the Trump tax cuts actually results in revenue reductions relative to the baseline. But the fact of the matter is that they do. And more importantly, based on our analysis, we studied about somewhere upwards of 8 to 10 different policy think tanks down in DC, and we determined based on our analysis that this is by far the most bipartisan and most experienced think tank down in DC with respect to creating these budget projections. They have two former heads of congressional budgeting process, one a Republican, one Democrat on their staff. So we have a lot of confidence that this analysis is sound. And going back to the actual analysis, current law, which again has the Trump tax cuts, the 2017 Trump Tax Cuts and Jobs Act, many of those provisions are expiring on December 31st of this year. Current law has the debt to GDP ratio accelerating to 125%, so roughly about 1,000 basis points from where we currently are. If you take all of these sort of proposals that President Trump outlined on the campaign trail and kind of put them into a policy mix, you wind up with 142% debt to GDP, and most of that is because we have a reduction in revenues. Now, again, he's not going to get everything that he outlined on the campaign trail, so we can assume that it's going to be somewhere between 125% and 142%, probably somewhere closer to 130, 135% in terms of the impact that we're going to see from all these this revenue reduction upon the budget deficit. So going back to this Doge process, if we get the budget deficit to, let's call it, even on a good day, down to 3% of GDP, just from taking a weed whacker to about $1 trillion worth of federal expenditures, we now have to then layer on the extension and expansion of the Trump tax cuts in terms of revenue reduction, and we might wind up back in the same place or somewhere near the same place as it relates to the deficit to GDP. My estimate is that we're probably going to see something like a perpetual 5% deficit to GDP ratio after everything is all said and done, when you factor in Doge and you factor in the legislative process with respect to the tax cuts.
Fascinating. So going back to the original number on the waste, the 500 billion that you identified from these unauthorized programs, is it just like the alphabet soup of the various federal agencies that were created in the New Deal? Is it just spending in those types of organizations that gets you to the 500 billion? What exactly is that?
Well, alphabet soup is a great way to put it. I want to say there was about 30 different categories of expenditures comprising that 500 billion. In fact, the largest category, I think, which is upwards of 100 billion, was spending on veterans benefits. And I think this was legacy sort of expenditures associated with COVID. I think they beefed up the VA and all the sort of services that the VA provided during COVID, and have not pulled those back. And so, again, it's not like anytime you're talking about reducing federal expenditures, it's going to have a downstream impact on the economy, because there's some human being or some state or some entity, organization, company receiving these nominal dollars in the form of income, or in the form of an income subsidy if you're not having to pay for medical services or things of that nature. So, we can have a political discussion about what's the appropriate size of the government, but that's not what we're trying to do here with our analysis. What we're trying to do here with our analysis is try to help investors, front run this legislative process, and ultimately what it's likely to look like from the impact that it'll have on the deficit and debt, because ultimately that's going to have a significant impact on the treasury market, and by extension all other asset markets.
Yeah, absolutely. And the 500 billion, like you mentioned, like at the end of the day, if you take that out, like it comes out of GDP. Is it one for one? Is there a multiplier effect? Is it a less than one multiplier effect? Like what's your take on that?
It's one of my least favorite things to discuss, because I mean, boy, if you look at analysis that tries to quantify the multiplier effect, for federal expenditures or just government expenditures to begin with, it really does depend on who produced the analysis. You either have rose-colored glasses or you have ice-colored glasses, if you know what I mean.
Yeah.
And so, the blue-colored glasses, the blue tint will tell you that the multiplier is at a minimum of one, and perhaps even higher. And the red side of the equation will tell you that the multiplier is a maximum of one, and likely lower. So again, I have not been able to find a credible source of analysis that suggests these government expenditures are high multiplier, low multiplier. But even if they're low multiplier, these are still nominal dollars that are flowing into the economy. So the multiplier is an integer positive to greater than zero. We know that. So at some point we're talking about a reduction in fiscal support for the economy, which ultimately, all things being equal, suggests a deceleration in economic activity. Now, the sort of kind of the right side of the equation, the folks on the political right would argue, if we reduce federal expenditures enough, and ultimately the deficit enough, you're talking about a reduction in treasury bond yields, a potential reduction in the policy rate itself, which would ultimately free up capital to the private sector and allow the private sector to kind of step in and take its place really seamlessly. And ultimately you have more higher productivity growth as a function of this sort of transition process. That's a best case scenario. The worst case scenario is you don't cut enough, but you wind up cutting enough to cause growth to slow, but you don't cut enough to have a significant change in the kind of rates on the treasury curve, on the long or short end of the treasury curve, and this sort of kind of replacing low productivity government spending with high productivity capital investment and even consumption in the economy. That process gets muddied up, if you will.
Yeah, absolutely. The 1 trillion in cuts that you think is possible, what's your best?
By the way, Nick, anything is possible. It's just
Yeah,
how you can identify what's the most probable.
yeah, absolutely. What's your take on like the percentage of that is related to salaries paid to government employees?
Not much. So when you look at the data for federal government employees is only about 1.9% of total non-farm payrolls. It's not a very big number in terms of salaries paid to federal government employees. There's a lot of procurement. There's a lot of, companies getting paid to do stuff for the government, a lot of contractual work as well. Don't forget, we have large categories of expenditures like Medicaid and welfare that, these are the two, if you think about the things that have not been ring fenced from this Doge process, I would say Medicaid and welfare, which are two entitlement spending programs and mandatory spending programs associated with the means testing associated with those programs. Those are the kinds of programs that Doge really needs to find significant reduction from, because a lot of the other stuff, it's going to come from very essential. I wouldn't necessarily say very essential, but things that the government might consider to be essential, right? Like, they can't. I'm sure the government probably pays Zoom a decent amount of money to have meetings like this. They can't just say we're taking Zoom to zero, right? You know what I mean? So I'm
Yeah.
using it as a stylized example, to illustrate the fact that this process is probably not going to be easy. And they kind of did it to themselves, right? You think about what they've outlined in terms of the categories that they sort of ring fenced from this Doge process. Three of those categories, these are the biggest categories of federal expenditures. So our friend Luke Groman, who I did a great discussion about Doge with in early December, that sort of front ran Elon Musk's own admission that they weren't going to even get close to $2 trillion. Took a lot of heat on that for that conclusion on Twitter based on this data-driven analysis. But it turns out the data-driven analysis turned out to be correct. Elon Musk has already outlined that that $2 trillion number that they initially outlined is just kind of it's a wishful thinking at this point, and that $1 trillion would be kind of a best case scenario. And that was in line with what we were projecting as well. So getting back into this analysis, the large categories of federal expenditures that have been ring fenced from this program account for about 61% of total federal expenditures. And again, this is Luke Groman's. He has this metric that we borrowed for our analysis, for the sake of our analysis, which is his true interest expense metric. So these are the things that the federal government says it won't cut. They're third rail politically. They're not going to cut until there's some sort of crisis that forces us to cut these categories. It's Medicare, which is our healthcare services for the senior citizen community. It's national defense. We're obviously in a fourth turning. The geopolitical world obviously continues to get increasingly complex. There's Social Security, which is income support for the retirement community, and then there's net interest, which obviously the government is powerless to do anything about. Those four categories account for $4.2 trillion of federal expenditures on a calendar year-to-date basis in December of 2024. That's about 61% of total federal expenditures, 14% of GDP, and they've grown. They've grown on a combined basis plus 11% in 2022, plus 17% in 2023, and plus 10% in 2024 for a trailing 3-year CAGR of plus 13%. And so the stuff that Doge is not focused on, and have been essentially been confirmed by Elon Musk and Donald Trump that they're not targeting, they're compounding at plus 13% per annum. And the reason they're compounding at plus 13% per annum is twofold. One, we have demographic challenges in the U.S. that are essentially making our, income support and medical support for the senior citizen community prohibitively expensive. And until we do something about it, those numbers are just going to accelerate. If you look at the U.S.'s old age dependency ratio, which is the 65 plus year old population as a share of the working age population. So the people who are, draining resources from the perspective of these programs versus the people who are paying into these programs from a tax-based perspective, that ratio is going to go from, just shy of 25% kind of right now to just shy of 35%. So basically 1,000 basis point acceleration over the next 10 years. So we know Social Security and Medicare costs are going to continue to compound at very elevated rates. When you think about the in terms of interest expense, just rolling over the current, the existing amount of debt, I want to say there's about $9.5 trillion of maturing debt in 2025. There's about another, we're talking about a federal budget deficit of around $1.8 trillion in 2025, at least project based on current law. And they were talking about the Fed, which is still, doing its quote unquote quantitative tightening program, aka balance sheet runoff. They're not selling bonds, they're just rolling bonds off their balance sheet. When you combine those three categories of potential gross U.S. debt issuance in 2025, we're talking about around a record $11.5 trillion of gross treasury supply in 2025. And if we, issue that, that's a minimum of value, by the way. If we issue that, we're talking about an additional $100 $150 billion worth of incremental net interest that we're going to have to expend on the existing stock of debt that is just getting more and more expensive as we roll forward in time and reprice the debt that we issued at all-time low interest rates in 2020 with the debt that is currently yielding, somewhere around 5%, pick your part, on the curve. So in our opinion, that true interest expense category is going to continue to compound at a double-digit rate as far as the eye can see. And everything else in the federal budget, which is 39% of federal budget, $2.7 trillion, that already has compounded at minus 12% per annum over the past 3 years. Now, it's going to continue to compound negatively. And in fact, it's got to get more negative based on what we're talking, based on this Doge process. But in our opinion, they're sort of, think about it, they're sort of running on a treadmill, if you will. They're not really making progress unless they, take a gigantic weed whacker to these, the entire, the other 39% of the federal budget that's been ring fenced, that has not been ring fenced from this Doge process.
Okay, so that's fascinating. So basically, going into this, the non-negotiables, those four categories, had been crowding out the other types of possible government spending at a pretty significant clip, right? Like double-digit declines in an environment that's been, the fiscal deficit has been growing significantly, every year during that same time. So it's a real crowding out effect, it sounds like.
It's crowding out the real economy as well. The size of the fiscal deficit at 7% of GDP. We have a record non-recession, non-war budget deficit. That is the fiscal situation that President Trump is inheriting from President Biden. Now, I would argue, just based on our analysis, again, we've been doing this analysis for years. President Biden made it a lot worse, but it wasn't exactly like he inherited a pristine fiscal situation from President Trump. Again, we cut taxes and expanded the budget deficit, so much so that President Trump grew the nominal stock of U.S. federal debt by 39% when he was in office. Now, you can exclude the last year of his presidency because it was COVID, and I'm happy to do that, but he grew it by 36% prior to COVID, right? You know what I mean? So, investors need to be aware that, the stock of federal debt has been growing significantly for an extended period of time, and part of it is because categories like Medicare, Social Security, of which I want to say Social Security is the largest share of federal expenditures, and the second largest share of federal expenditures is Medicare. So the two largest shares of federal expenditures are Social Security, Medicare. Those are ring fenced. We know net interest is ring fenced, and that'll be the second largest share after this year once we roll into a higher interest rate regime with that debt that needs to be refinanced. And then you're talking about what else? National defense, which in our opinion is probably not going to go down. So these four categories, which are the largest four categories of federal expenditures, comprising currently 61%, which is probably on its way to 65, if not 70% of the federal budget, they're not going anywhere, and they're not even being addressed. And so in our opinion, the situation that has contributed to a significant hawkish repricing of term premium in the bond market, this sort of the U.S.'s loose fiscal situation that has contributed to that is likely to persist after this Doge and tax cut process and tariff implementation process is done. Now, investors we have to figure this out as investors along the way. It won't be a straight shot because we're going to be talking about different policy proposals and different paths we can take to get to the ultimate destination. But in our opinion, the ultimate destination is one where we don't have significant deficit reduction. I still think we're going to wind up with a budget deficit that's compounding somewhere around 4 to 5% worth of GDP at the end of this process, and that's not good enough, in my opinion.
Yeah, absolutely. Let's talk about the four non-negotiables for a second, because as I've been sort of getting ready for this discussion, I keep going back to those four and just thinking through, that's sort of where the real meat is. And so if you really cared about putting the U.S. on a long-term sustainable path with respect to the deficit, you have to address those. And some other countries around the world have begun to address those. So take Social Security, for example. If you want to address Social Security, the answer is you either have a bunch of immigration, so there's more young people working here, which is politically unpalatable right now, or you raise the age. And I feel like, aren't the fights in Europe essentially about the politicians recognizing the fact that they have to raise the age at which you get benefits, and then people protest because they're angry about it? I feel like that's happening already, and it's probably going to happen here too, because people are going to do this math after the initial, hype of this process wears off and people kind of come to the truth. And then I can say, okay, well, I guess Social Security is back on the table if we care about the deficit. What's your take?
It's not on the table. It won't be until we have a crisis that we have to, an existential crisis that we have to
Yeah.
deal with in the context of this in this fourth turning. And the reason I say that with such conviction is that we understand that part and parcel to this fourth turning process is the fact that we are starting from a very a condition that requires populism from the federal government. In fact, I'll show you one quick chart. So this is our investing during a fourth turning regime analysis, where we show, you know, you go into these four turning processes, usually income inequality and wealth inequality are at very, kind of dangerous levels, if you will, going back to the, 1929 and where we are currently with over 50% of national income going to the top 10% of households. I mean, that just sounds ridiculous if you say it out loud. And so in our opinion, this is contributing to a condition in the economy whereby the median voter is demanding populism to address that what they can very clearly feel is as a loss of purchasing power, a loss of economic security, certainly relative to the haves, and the growth rate of the have-nots in our population is accelerating dramatically. It has accelerated dramatically, and folks are demanding populism to offset that. This to me is one of the most important charts in all of macro and has been for over a decade now. First time I created this chart was sort of in the early aughts. And in my opinion, I think this chart, I don't want to take too much credit for this, but my former colleague and one of my mentors, Neil Howe, who created the fourth turning framework, obviously Steve Bannon is a huge fan of that framework. In my opinion, I think Steve Bannon probably saw this chart or saw Neil talk about this chart at some point and ultimately convinced Donald Trump to run for president on a populist platform, in my opinion. So this chart is, again, one of the most important charts there is in macro because it explains the contours and the volatility of the U.S. political cycle. So the blue line in this chart shows labor's share of national income using gross domestic income as a proxy and nominal employee compensation as a proxy for that. It's down essentially at an all-time low of 52%. The red line shows capital share of national income. So looking at corporate profits as a share of gross domestic income. So that 52% ratio for the blue line, as I mentioned, is an all-time low. It used to average in the 40 years from 1960 to 2000. That statistic averaged about 56%. In the 40 years from 1960 to 2000, corporate profits as a percent of GDP or profits as a percentage of gross domestic income averaged about 9%. So there's been a 400 basis point swing from the long run mean of the labor share of national income down to the current level. And there's been a commensurate 400 basis point swing in corporate capital share of national income in the form of corporate profits to higher to the current level. And that doesn't sound like a lot. 400 basis points doesn't sound like a lot, but it is significant for the median American family. You're talking about based on current data, 2024 data, you're talking about a $1.2 trillion of lost income that's being siphoned from the household sector into the corporate sector on a per year basis. And so when you kind of do the math as it relates to what does that mean for the median household, you're talking about roughly about $9,000 of annual lost income per private sector employee, which is roughly about 11% of the median household income. So households, since we've sort of, kind of let China into the WTO, signed one of the worst trade deals in history with NAFTA, and ultimately kind of pursued this, very anti-populist policy of globalization and shipping our jobs to Canada, China, Mexico, elsewhere. Since we started pursuing those policies aggressively during the Bush administration, the GW Bush administration, and obviously they've been carried on by Barack Obama. They've been carried out by, to some degree, Donald Trump, because we see the statistics. We've seen to some degree by President Biden as well. Those policies, in my opinion, have contributed to what has been a kind of minimum, a loss of around 10% of annual household income for the median household in the U.S. And more importantly, that lost household income is going to the rich people who own all of the capital assets in the economy, who own all the stocks and who own all the businesses. So this has been a regressive tax. This policy of globalization has been a meaningful regressive tax on the median American voter. And so this goes back to where you want to take discussion, Nick, which is, are we ever going to see significant reductions to programs like Social Security, Medicare? And my answer is not until we're staring down the barrel of a gun, which is ultimately the climax of this war-turning crisis.
Yeah, this is an incredible chart, and I'll make sure it's available for everyone who's sort of listening. I'll include it in the distribution when we announce the podcast, because it really is incredible. It makes me actually think that what we're seeing in sort of places where I live in New York City, like these big liberal enclaves, is that this wealth inequality is sort of operating on steroids and has created a really broken political process where the top 10% pay an enormous percentage of the taxes for the state and for the city of Los Angeles, something like in the 90s or whatever. But they have no voting power because just from the nature that they don't form a majority. And so the populist politicians have captured the government at essentially all levels. And it's an all out assault against business owners and property owners and wealthy folks, people of high income.
Well,
There's
don't
tax.
forget the assault is coming for a very legitimate
Yeah.
reason.
Yeah.
Broken had been a very long-term social contract in America, whereby labor share of national income averaged somewhere around 56% of gross domestic income, and corporate profits averaged just shy of 10%. That big cavern in the chart, that big shift in the chart to where we're at all-time high corporate profits and an all-time low of labor share of national income. In my opinion, that's why there's been an all-out assault from this populist movement. In my opinion, I think there's already been a significant regeneracy in this fourth turning, whereby Donald Trump has realigned the Republican Party along with the ideals and core beliefs of the median populace. It used to be the Democrat Party was the party of populists and poor people who demanded more resources from the government. Now the Republican Party is the party that that is most associated with that belief system, and so they're going to have a hard time legislating what is a kind of a mishmash, if you will, of laissez-faire Republican, Reaganomics with, the enormous demand for populism from, the median American voter. And I think it's ultimately going to wind up with, there will be meaningful deregulation, there will be meaningful tax cuts, but there's probably going to be meaningful tariffs offsetting that. There's probably going to be a significant reduction in border crossings and immigration offsetting that. That has two negative ramifications. One, you're talking about a tighter labor market, which ultimately inflates wages and unit labor cost inflation. But you're also talking about potential reduction in the growth rate of the working age population that, whose income is being taxed to, kind of offset the growth of Social Security, Medicare. So, I think you're going to wind up with this hodgepodge of policies that we, quite frankly, have not really seen before in U.S., at least in modern U.S. Economy. So, I think it's important for investors to turn to frameworks like the fourth turning to have a longer term, longer horizon, multi-country, take on these very important dynamics. Because
Yeah.
ultimately, stuff really matters to the bond market.
Yeah. Well said. And these things, because of this populist impulse, right? All these policies are working at cross purposes.
Yeah.
Right? It's hard to be a Reaganomics Republican leader and yet engage in populist type policies. And,
Well, it's a
and
good thing you think we're going to find out what it
yeah,
goes. Yeah.
yeah, like this Doge, intellectually, like I'm really supportive of the idea. Like I feel like like another category which we didn't talk about, like the DoD. I feel like even if you looked at the DoD, which is kind of sacrosanct, like there's waste for sure in the DoD budget. Absolutely, there's corruption. There's just straight up government efficiency and inefficiency. And if you were to take that out, there'd be room for other spending. To pursue. Like let's say you didn't want to reduce the deficit, but you wanted to engage in helping Americans through populist policies. Taking waste out of the DoD budget could help a lot of people. You could expand Section 8, you could expand welfare. The sky's the limit, really. One question, I know we're running short
By
on
the way,
time.
by the
Yeah,
way, I think we still need to acknowledge the fact that if the Department of Defense, what is it, what are they about just shy of $1 trillion of money goes into the national defense. So on a calendar year to date basis, it's through December, it's $898 billion, probably on its way to $1 trillion in a year or two. I don't know what the number of waste, fraud, and abuse is, but I got to imagine that there's a company like Palantir on the receiving end of that waste, fraud, and abuse. So how much of the sort of tech companies that do great, amazing things for our U.S. government and for society, how much are they on the receiving end of all that quote unquote waste, fraud, and abuse? I don't know if we know the answer to that. but I think it's going to be a more messy process than I think the sort of Elon Musk fan club, if you will, who if you say anything that isn't what he wants you to say, you generally get attacked online. I've experienced that, but the reality is, I have no fear at all, confronting that kind of lazy analysis, because at the end of the day, our research is backed by data-driven, statistics that, in my opinion, are some of the best in the world.
Yeah, absolutely. Yeah, it's a good point. Like every single one of these tech companies has huge contracts with the government.
Every
It's not just Palantir. It's like even Amazon has like cloud deals with them. Like they're
Well,
all
what
in.
happens when Elon Musk finds out that Tesla is part of the government waste, fraud, and abuse? I mean, they get tens of billions, if not hundreds of billions of dollars a year from the government, right?
Yeah.
And SpaceX too. Yeah.
Yeah, absolutely.
Yeah.
One question, just this is kind of a hypothetical, but I've just been thinking about the other big category of the four non-negotiables is the interest on the debt. Obviously, we got to pay that. And I don't know enough about how the whole like process of the bond issuance works and the auctions and all that. But one of the thoughts I had during the COVID era was that, and I never understood why they didn't do this, is why didn't the Treasury just issue like 50-year paper and then have the Federal Reserve just buy it? Because it strikes me as really dumb, like as a real estate operator, like why would you have all this short-term paper when interest rates are zero if you could lock it in? And especially when you're doing this crazy mechanism of the QE transaction where the Fed is essentially buying the debt. I know it's not quite directly like that, but what's your take on an idea like that?
This is a loaded question. So several things. So one, there's no demand for this paper. No one wants to buy a 50-year bond at 0% interest rates, right? We all understand that interest rates during COVID, anyone who's operating in the bond market understood that the interest rates are probably going to go up from there. The U.S. does not have the kind of demographic challenges that would, keep you in a negative interest rate regime for too long of a period of time. So by the way, they tried. They tested the market. The Treasury Borrowing Advisory Committee did, do research on here's a 50-year U.S. Treasury bond, et cetera. I don't know if they got out to 100 years, but the response rate was no, we don't want this. I don't want to lock my capital up for 50 years at 50 basis points. That's silly. So the response is there probably wasn't really much demand for those securities. And secondarily, with respect to going back to COVID, so in COVID, so from the beginning of 2020 through 2021, you can just sort of lump all federal expenditures, not all, but some large category of federal expenditures was associated with the excess COVID spending, such that I want to say we had about a $4 trillion budget deficit at some point in 2020. Yeah, the budget deficit was $3.3 trillion in 2020. And in 2021, the budget deficit was $2.6 trillion. So, we had a significant amount of expenditures associated with just COVID. The Fed so the Fed public debt grew $6.2 trillion from the end of 2019 through the end of 2021. The Federal Reserve monetized 52% of that. So they did monetize a lot of that debt that you identified, but they can't do it in like a one-to-one format, right? One, it's illegal. They can't explicitly capitalize the U.S. government. And number two, I don't think they want to, because I don't think they ever want to send a signal that explicit debt monetization is a stated fiscal policy of the United States of America, given the damage that would do to our credibility and our exorbitant privilege. So there's that on that. And then thirdly, with respect to the bill financing that the Treasury decided to do during COVID, a lot of that bill financing was again a function of a lack of demand for longer-term Treasury securities. Recall that in March of 2020, we actually had a spike in real interest rates as foreign creditors started to sell Treasuries en masse because the dollar had gotten too strong, right? So the Treasury Department, understanding this, recognizing this, said, okay, let me just give the market what it wants, which is a bunch of short-term paper, short-term debt instruments, so in the form of T-bills and other short-term notes, securities. So in our opinion, it's not as simple as let's just take everyone's money for 50 to 100 years at interest rates that don't make any sense. I'm an investor, you're an investor. We're not dumb enough to do that. So that you have to assume that the median investor out there is not dumb enough to allocate capital in such a manner that would be so explicitly favorable for the United States government. I think the key takeaway for this discussion, Nick, is that there's no simple solutions. There's no easy way out. In my opinion, I think the bond market is kind of the epicenter of the fact that there is no real easy way out of this mess, right? If you think about the Treasury bond market, in our opinion, we've had a significant hawkish repricing in Treasury bond yields. I want to say they're up almost 100 basis points since the Fed started cutting rates back in September. I want to say about 80 to 90% of that increase has come from the expansion in term premia, which is the excess yield you receive as an investor for taking illiquidity risk in the bond market. So instead of rolling over, short-term bills for the same amount of time for 10 years, what's the incremental yield you would get on top of that for just buying a 10-year treasury and locking your money up for 10 years? And right now we've seen an expansion of term premia go from negative, persistently negative, from really basically 2015 all the way through the most recent, all the way through 2024. And we've seen an expansion of term premia such that they're about 58 basis points wide. That 58 basis points, so that's 58 of the 10-year treasury yield's 457 basis points right now. 58 basis points of that 457 basis points is term premium. It's just the excess yield you get for locking up your money in the treasury market and taking on illiquidity risk. But that 58 basis points is well shy of the long run mean of term premium. The long run mean of term premium is about 150 basis points. And so if you subtract the deviation from that long run mean of term premium from the current 10-year treasury yield, you actually wind up with a 10-year treasury yield that would be 5.45%, all things being equal, if we had a quote unquote normal level of term premium in the bond market, which I would argue you can make the very strong case that you can say we should probably have a above normal level of term premium in the bond market, just considering the fact that we have these, kind of burgeoning deficit and debt concerns. Again, we're at a record non-war, non-recession U.S. budget deficit of 7%. Even if they cut it, it's our estimations based on the analysis that we've performed with respect to federal expenditures is based on and federal revenues, is that we're probably going to wind up with somewhere that's still somewhere, kind of at or around 5% in terms of the deficit to GDP ratio. So we're still on an unsustainable path from a fiscal perspective. And so that unsustainable path that we're still likely to wind up on suggests that we should probably have at their bare minimum normal level of term premium, perhaps a higher than the normal level of term premium. And one final thing I'll say on all this is, if we actually reprice the bond market to have an appropriate level of term premium, which is again right around 5.5% on the 10-year, we'd be talking about inflation break-evens on the 10-year somewhere around 3.3% as opposed to 2.4% appropriately or currently. And so in our opinion, 5.5% on the 10-year, 3.3% on 10-year tips break-even is a much more appropriate pricing in the bond market to account for these kind of unsustainable fiscal dynamics that, in our opinion, are only going to deteriorate from here in a fourth turning. Recall that if you believe the fourth turning, which, by the way, if you haven't read the books, shame on you as an investor if you haven't read those books. It's probably two of the five most important books that have ever been written with respect to investing and understanding geopolitics and the economy. So definitely make time to review Neil's work on that. If you believe the kind of core premise of one of the core premises of the book is that fourth turning crises always end in a big bang crisis, typically war, but it may be something else. Could be climate change. Obviously, we'll pivot to talking about what's happening in LA because you have boots on the ground there, both personally and with your business, obviously. And then it could be something as asteroid in there. We don't know. We literally don't know what that crisis is, but we know historically it's always included a complete mobilization of public sector resources and a significant advancement in sovereign debt and deficits. And so we're already on this unsustainable path prior to the quote unquote comet hitting us and having an Armageddon moment or significant climate change or total war associated with the decoupling of US and China. I don't know what it's going to be. No one knows what it's going to be. Neil won't even tell you what it's going to be because he doesn't know. But the reality is we're certainly, when you look at the mile markers in this thesis, we're certainly on that path. And you got to be very concerned about the bond market long term in the context of that.
Yeah. Wow. That's a sobering thought, but I think you're right about the bond market. And I feel like people are starting to wake up to the fact that 10 years going higher from here, and rightfully so.
It's just mispriced. It's just, there's no way you need a 4.5% 10-year treasury yield in an economy that's this resilient, an economy with this much fiscal support, and an economy that has, inflation persistently surprising to the upside relative to the Fed's mandate. This is something that's a whole different conversation we don't have time to unpack today, but I did want to unpack before we left today your thoughts on what's happening down in LA. Obviously, my thoughts and prayers out to everyone that's been severely displaced and impacted by this horrible tragedy. You run I think you co-manage a large real estate fund with properties all around the country, but you do have some concentration in Southern California. So talk to me about what you're seeing on boots on the ground there.
Yeah, absolutely. No, thanks for bringing that up, and thanks for your thoughts. It's been a crazy start to the year here, and I know so many people who've been impacted in like such a personal way. Fortunately, it's been relatively safe. There's been tragic loss of life, but the rapidity of the fires, the way they came, it could have been a lot worse. So thank God it wasn't, a crazy event. But on the property front, people's lives are really disrupted, and thousands. I think it's like 12,000 or something. Schools are shut down. Schools have burned down. Tons of preschools have burned. So like everyone's there's a lot of families who are basically in flux here, and that part of the story is just begun, sadly. And on the business side of it, it's really changed things in this town. Like if we had had a discussion in December of 2024 about, hey Nick, what's your forecast for LA for 2025? I would have been really bearish. Down, rents down 20% outright, and maybe house prices too, because the mortgage market is completely destroyed. The for sale housing market in this town, all across the country, but this is a very expensive town. So
That's a very loaded statement. Why do you say the mortgage market's destroyed?
basically, the from years and years and years of bad politics locally and artificially suppressed interest rates, arguably at the national level, created this toxic soup in LA where the price of real estate went up and up and up. And so we went into the 2022 period with one of the most expensive housing markets ever, super tight. Homelessness was growing, massive problem because of affordability. And so we already had a crazy expensive market, and then borrowing costs like tripled. And so now it's completely out of reach. Unless you happen to be like a very elite wealth or income status, like buying a new house in Los Angeles is out of reach for almost everybody. And everyone keeps waiting for rates to go down. But as you just discussed eloquently, like it's not happening. Hasn't happened and doesn't look like it's going to happen. So it was really slow. We were seeing really long listing time periods in 2024. We were seeing if things sold, it was with a price cut for sure. And I just forecasted it. It looked like more and more of that was going to happen. And now the dynamic on the ground has completely changed. There's 12,000 people, 12,000 families who are looking for a place to stay. And it's sort of single-handedly saved Los Angeles, at least, from a nasty 2025. I think Los Angeles is going to feel the pain later. Like a year from now, everybody in this town is going to have more expensive insurance, and maybe like significantly more expensive, unless the government
They can get it. I got to
if they
imagine.
can even if you could even get it. So 2025 is going to look good on paper in LA. I think you're going to see very positive numbers on both the for sale metrics and the rental. But it's really just artificial. You throw 12,000 people at a supply constrained market like Los Angeles who are like trying to get something immediately, and it's going to cause the market to sort of go in the direction that most people don't want it to go. Right? We don't want any more inflation and rents in Los Angeles. It's already too expensive, but that's what's happening.
Yeah, it's a good way to summarize it. So you have a reduction in supply, the maybe like artificial boost in demand, and it results in higher prices.
Yeah.
If only for a transitory period of time. But I mean, again, inflation is what's happening at the margin, not what the price level is, right? And so I got to imagine that's not going to be given just the sheer size of the LA housing market, Southern California housing market, because this is not just going to impact LA. We're talking about downstream and Newport and San Diego, et cetera. Not sure what's too far up. Santa Barbara, I got to imagine this is going to see influx
Yeah.
of people as well. So this is going to have some regional impact, and it may have some impact on national statistics. I think it's too early to kind of ascertain those kinds of things. I've been, with the hurricanes down in the southeast last fall, Irene and Milton, they didn't have as much impact on the economic statistics as I thought they would have, which ultimately means that there wasn't as much displacement and new building that we're probably going to see in Southern California. So even though the scale of the fires may be smaller just in geographic terms and in terms of the actual number of families that were impacted, it may wind up being as big just from a pure economic sense because you have more rebuilding to do, more home purchases to do. and stuff like that. So we'll see.
Yeah.
Make any assumptions on that.
I never thought about the hurricane examples, but do you have an idea of how many houses get destroyed in those big events?
No idea. I don't want to make a
Yeah. I'd be curious to know that because it's probably not as much as got burned because when it burns, it basically is gone. And so that's more like weather damage. And so the structures are still there, probably. They need work on them. Um, yeah.
exactly. That's my
Yeah.
point. Like it's you know fixing weather damage is way different than we need to clear all this out and build a new house. That's
Yeah.
just there's way more of an economic impact there. So
Yeah.
we'll see. I mean, it's just going to make you know my job, our job as investors, harder to do. Trying to fold in these sort of one-off dynamics. But I think at the end of the day, some of what we're talking about is sort of underlying kind of price pressure in the U.S. economy is consistent with where we've been with respect to our structural inflation theme, our sticky inflation theme, which we authored back in January of 2022. We think the equilibrium level of core PC inflation in this economy is high twos, low threes. Equilibrium level. Now we might slow below that for a period of time before we start to reaccelerate higher, back above that. But going back to the prior decade, equilibrium level of core PC inflation was somewhere around 1.6%. We're talking about almost a doubling from that level, and it's a function of deglobalization. There's way more cash floating around the economy in terms of in terms of what the cash we can spot on household sector balance sheets. You're talking about a significant reduction in housing supply relative to household formation. You're talking about a reduction in labor supply that's contributing to persistently above trend wage inflation. The economy changed significantly in COVID, and I think there's a large faction of kind of consensus mainstream economists that keep trying to model us back to prior to COVID. And I think that is a very faulty assumption. In fact, I think we've had some of the best economic calls on global Wall Street over the past few years because we understand that we're not going back to COVID. I think I would put Jim Bianco up there in that category as well.
Yeah, man, absolutely. You've been helping a lot of investors and people like me who are not necessarily, investing directly in public markets, but just in understanding. I highly recommend people, if you have any interest in geopolitics and understanding sort of the relationship between what's happening on global Wall Street and macroeconomics and geopolitics, you should follow Darius and look into 42 Macro. I find it super valuable
Yeah.
just to keep my head on what's going on. Yeah.
Thank you so much, man. That means a lot. I appreciate you, man. You're one of the good people out there doing great things for the world, and you got
Thanks, man.
man. And I've always enjoyed your content, but just you as a person too, man. Keep doing what you're doing because you definitely have an impact as well.
Thank you. Well, Darius, thanks for sharing so much of your time. This was a fascinating episode. I think people are going to walk away with eyes wide open and having to maybe want to do some more research. And I'll point them in the right direction when the time comes.
Check us out, 42macro.com, man. I think we can help. I definitely think we can help.
All right, Darius, be well.
Cheers, man. Thank you.